Good afternoon. Time to have a look at what happened from a markets perspective, starting off with things in Asia. We did see those markets opening a little bit higher, and this is on the back of the technology stocks that jumped based on what we saw overnight on Wall Street. So as a result, the Hang Seng Index up 4%. Markets in Japan closed for a public holiday. European markets are firmer, and that sentiment is trickling down to our local markets. All share index up 1.6%. We are led higher by the resources and the industrials, and the financials just bucking the trend there in negative territory, down about 0.1%. But I had a conversation with the finance ghost, and we looked back at the key themes that dominated markets in the past week, starting off with Old Mutual's BEE scheme proposal. Have a listen.
In my previous life in investment banking, I used to help structure some of these things. So I think I've got a reasonable inside track of kind of what works and what doesn't. And I think above all, what the risks are in these structures, because I think in general, they're quite poorly understood. So, just some of the high level stuff, the way these deals works, inevitably there's a special purpose vehicle, which is just a company set up specifically for this, called an SPV for short. And either the listed company or a bank lends money to this entity, and that entity takes that money and uses that to subscribe for shares in the listed company, and that is how these empowerment deals are inevitably done. Now, in order to get equity in the right hands, in the hands of black shareholders, the entity becomes black owned. Either the public is asked to, subscribe for shares in it, or it's placed with black private equity investors, for example. But the point is, these black investors are buying a very, very leveraged exposure to the listed company. The old advice is don't borrow money to buy shares. Now, that advice isn't always true, but in this case, people don't realize they're often buying into a structure that has, at times 75%, 90% debt, depending on which one it is. And that's obviously really risky, because what you're relying on is the dividends from this listed company to actually pay down that debt over a 5-year or a 10-year period. And anyone who has spent any amount of time in the market knows that this stuff is never guaranteed. Also, dividend yields are often much lower than the interest costs. So what can happen is, over that period, the debt actually can build up. And at the end of it, when everything is unwound, shares are sold, the debt is settled, and the black investors are effectively left with whatever is left over. And it's a little bit of a lottery, I'm afraid, because these structures technically have a specified end date, and depending where you are in the market cycle can determine the outcome for investors, because they are effectively forced sellers at that time. If it's a bear market, bad news. If it's a bull market, fantastic. So, these things are not always amazing investments, to be honest. And I just think that investors need to be very careful when looking at them, recognizing what they are buying.
In an environment like this, I suppose, where some of the companies who've reported numbers recently are saying that they're expecting some constrained trading conditions, and you immediately start thinking about the consumer who's under pressure, what's your assessment then on SA food producers?
So food inflation is great for food businesses to a point, because it lets them increase prices. But too much inflation is a big problem, because consumer spending falls over and so do volumes. So what you need to think about is, what are the input cost pressures that the food producer is actually facing? If these are huge spikes in input costs, then they can't always be fully recovered, and that can cause big problems on margins. And some of the poultry companies, for example, experienced that last year. But one of the most important things to remember is that the retailers, the grocery stores, they own the customer. You are never going to go and buy your basket of groceries from all the different food producers online. It's not going to happen. They are the aggregators. They are the distributors to customers. And retailers have private label strategies themselves, which means they actually compete with their suppliers. So in tough times, which product do you think retailers are actually going to push? And do you think they will allow food producers to put through big increases? And this is especially bad for food producers of more commoditized foods, which is why I'm very bearish at the moment on a company like Tiger Brands. Conversely, branded stuff actually becomes more resilient in these periods, and especially in certain categories. So one thing I've noticed, for example, in snacking, people want a cheat meal, chocolate or your favorite chips. You're going to buy the one you really love. You're going to get the most out of those calories. And for a great international example of this, you could look at something like PepsiCo. They own Lay's, Doritos, doing really well at the moment, whereas other food producers who sell, bread or milk or real commodity stuff, they don't always do well in a time of tough consumer spending and high inflation.
Which is a nice sort of segue into my next question. When we were looking for, pressures or signs of pressure from an inflation point of view when we look at U.S. earnings, and that's kicked off. It's been about a couple of weeks now. What do you make of U.S. earnings season so far? Have you picked up any interesting trends?
Yeah, it's been fascinating. I mean, the growth stories have been cracking, and they've been cracking quickly, haven't they? We're seeing big cost pressures. These highly paid developers in San Francisco, they're not cheap, and they demand big increases, lots of share options. There's a big battle for talent in the tech industry. And what you're seeing is margins are going the wrong way because revenue growth is starting to slow down, whereas cost growth is going bananas. And more importantly, people are finally starting to look at the correct measures, stuff like free cash flow rather than just revenue growth. I mean, we've all seen what's happened to Netflix, which is a company I've warned about multiple times before. So a lot of these companies are falling flat. You're seeing after hours moves of over 20% in some of the biggest names in the world. It's just breathtaking, honestly. And, we're seeing really huge battles playing out in some of these tech companies like the social media stocks. And there are other sectors that are offering good value. In my Magic Markets premium work that I do with Mohammed Nalla, we see interesting value in companies like AT&T at the moment, Hasbro, more like traditional stuff, that people forgot about when they got all excited about tech.
So you mentioned Netflix, and you touched a little bit on those social media stocks. So is there an upside in whether you are looking at the streaming services or you're looking at social media stocks? I mean, where do you stand in that regard?
So I'm still not buying Netflix, not even at these levels. I think the economics in this stuff is still worse than people realize. The costs of producing content are enormous, and it's for a captive audience. So it's a really tough model. It's not like the box office blockbuster. You make a movie, you make a fortune, you move on. In the social media stocks, I think that Meta is still good value at these levels. So that's Facebook. I bought that huge dip after the last result, and then it dipped more. But, when you buy something, understanding why you've done it, that doesn't always worry you. And sure enough, it's kind of come back to those levels now. And I do believe that with a long and volatile road ahead, it's going to be fine. Alphabet, that's Google. That's not technically a social media company, but they do have elements of that. Just really great business and lots of value at the moment. I think that's something I'm looking to add to my portfolio now. I already have a position there. And then one that deserves a mention because it's partially a streaming stock is Disney, but it also has significant exposure to upside in tourism. And the problem for Disney at the moment, there's a lot of noise around the company. There's some people who are very upset with the content on Disney Plus. There's also issues around the land in Florida. So, I'm not adding to my position in Disney currently, but it is one that I hold that arguably is in that streaming play.
Well, that is it from me. We will be back on Tuesday with our market segment. Have a fantastic weekend. But for